we'll be looking at an overview of the indirect method to prepare the operating section of your statement of cash flows. Remember, there are two methods that can be used to prepare the operating activities section of the statement of cash flows, the direct and the indirect method. We'll be focusing on the indirect method since about 98% of companies use the indirect method to prepare their statement of cash flows. So your starting point under the indirect method is net income. You start with net income. You get that from the company's income statement, the bottom line. To net income, you're going to make a series of adjustments, 3 types of adjustments to be exact. The 3 adjustments are, first, you're going to add back non-cash expenses. Those are any expenditures that show up on the company's income statement that were not in fact paid in cash. So some common examples are going to be depreciation expense and amortization. Again, those are accrual-based expenses not paid in cash. After that first adjustment, you'll go ahead and make the second adjustment, which is to adjust for any change in account balances in current asset or current liability accounts. This one's probably the hardest of the 3, and so in order to help you with this second adjustment, we've supplied to you a little matrix. I did just a little quick version here, but there is a more thorough version in your textbook and in the slides to the chapter. So basically you're going to look at your current asset accounts and your current liability accounts. You'll find those on the balance sheet. If the balance has increased from last year to this year, you'll deduct the change from net income. If the balance from last year to this year has decreased, you'll add it back to net income. And the opposite is true for current liabilities. If you had an increase in current liabilities, so for example, accounts payable, $100 last year, $200 this year, you had an increase, you're going to add that, whatever the change is, the $100, to net income. If you have a decrease in current liabilities, you would subtract that from net income. And the way to think about this, and they do have examples in your book, the way to think about this is, let's use an example here of a current asset. Let's take accounts receivable, money that is owed to us from our customers. What would cause that account to increase from last year to this year? Well, a common example would be if we had some sales that happened on account, because the journal entry for that would be accounts receivable, debit, credit to sales. So the way to think about this matrix is that sales increased, that's great, and accounts receivable increased. Okay, remember our starting point with the indirect method is net income. So how did this transaction affect net income? Did net income increase or decrease from this increase in accounts receivable? Well, sales increased, right? So if sales increase, is that going to increase or decrease your net income? It's going to increase it, right? So net income is higher on our income statement, but we're trying to get to cash flow. Did we receive this sale in cash? No, we received it on account. So that's why you have to go ahead and take that change, that increase, and subtract or back it out of net income. Does that make sense? It all has to do with where we're starting in the indirect method. Starting with net income, an increase in a current asset, such as the example we provided here, would lead to higher net income. However, that net income was not realized in cash, so we have to take it out of our income statement. So again, this is examples, and we could do an example for every section of this little matrix here. And in fact, your book does provide you examples for each one of these. If that's a little too hard, you can just go ahead and, memorize this matrix and have it help you in this chapter. All right, so that was the second adjustment. The third adjustment is to add back any losses or subtract any gains that the company may have experienced during the year. You would find that information on the company's income statement. If they had a loss on sale of equipment, loss on sale of land, any type of loss or gain, that would show up on the company's income statement. You're going to want to add back the losses to negate that effect, or subtract the gains, again, to negate the effect. Why are we doing that? Why are we taking out that loss or gain? Because we're trying to get to cash flows from operating activities. Now, remember, when you sell a fixed or plant asset, that does not go under the operating section. Okay? That goes under your investing section. So we would take it out, because right now it's in net income, that gain or loss. If we had a gain, it's increasing net income. We want to back it out so that we can get to cash flows just from our operating activities. And then we would show that gain or loss under the investing section of the statement of cash flows. So hopefully this quick overview of the indirect method to arrive at your operating activities on your statement of cash flows has been helpful.